Framework for preparation and presentation of financial statements. Specifically for Ind AS, for AS also we have this. This was changed in the year 2021-22 by IFRS, and correspondingly Ind AS also have made the changes. Because of this, many people are afraid, oh, there has been a lot of changes in the framework as compared to the previous one. There are changes in the structure, but conceptually they are not really going to matter much, either from your other standards perspective or from examination perspective, but still some people are afraid. So let us go through this content in slightly detailed manner to gain confidence. So what do you mean by the concept of framework? It is meant for standard setter. This one point itself will clarify everything about this point, about this concept. This framework is not really for the people to implement. See, it is like a preamble. Like when I am preparing an accounting standard, think from the standard setter, like a legal authority. What is the guideline that I should follow? What concept I have to follow? So it's more of an introspection or internal guidelines. It's meant for standard setter, but for students, everything is applicable, so we are reading it. But a primary objective of this exercise is to give guidelines for the legal authorities who prepares the standards. And you have to provide a consistent accounting policy, then only uniformity will be existing. So it is not a standard and it does not override any standard. So if there is a conflict, you always follow the standard, not the framework. And evolution of framework is started in 1989, and in 2018 the accounting standard, International Accounting Standard Board have given some revised framework. That's what we are introducing in our Ind AS also. Okay, so what is the general purpose financial reporting? So when we prepare balance sheet, P&L, when we have a reporting, right, what is the objective of those financial statements? Financial information to the existing as well as potential investors. For both kind of people, if you want to know information about the company, this statement, this general purpose statement, financial statements should give sufficient information. Information about what? Economic resources means assets. Claims means liability. Changes in those resources, basically like a P&L account, and cash flow during this period, what happened. And the objective is you can assess the amount of timing of future net cash inflows. See, for example, I am an investor in stock market. I would like to buy a company called as Praj Industries. I don't know whether you know what do that company do. The Praj Industries is a manufacturer of machine for ethanol products. Now, I want to understand what do you think will happen to this company, how much liability they are having in future, how much assets they are having in future, how much cash flow they can generate. So what is the present value of future cash flows for me to arrive at intrinsic value? Discount cash flow method, FCFE, FCFF. Just give an example. So to assess about the future, I need to know their current financial position. And current financial position should help me estimate what could happen in the future. Of course, nobody can give future guidelines, but you can at least able to assess the company's financial position. That's the objective of general purpose financial reporting. Limitation, balance sheet cannot provide all information, not designed to show the value, in the sense, by look at the balance sheet, you can't tell what is the value. They're all showing book value, but what is the intrinsic value? You should only arrive at it, and different people have different points of view. So for each person, value will be different. So the purpose of reporting is not to design to show the value, but to help you estimate. You should be able to make use of this and estimate a value for yourself. And it is not primarily directed to other parties. So it is mainly for investors and any interested people, and not for any specific special purpose. That is not the reason why these financial statements are prepared. These charts, I'm not sure whether it is there in the material. So you can do one thing. You can take a quick screenshot of this, maybe previous one also, right? Then you can copy it down later. So you can take a quick screenshot. Maybe what I'll do. Okay, yeah, you can take a quick screenshot. I'll share it also in my Telegram group later. All these charts that is related to the framework. At this point in time, you can take a quick screenshot. Okay, general purpose fund statements. This screenshot also you can take it. See, basically what I've done in these charts, I've looked at the study material, no other textbook, and I've tried to simplify it with the help of charts. Because on day before exam, reading everything from institute material can be too lengthy and can be frightening. So with the help of charts, you can quickly glance it. That's the purpose. Okay. Qualitative characteristics of the financial reporting. So I'm not sure whether it's readable. So I'll try to make it into smaller piece. And then we'll look at that once more. Okay, fine. So qualitative characteristics of financial statements. They focus on actually two simple words. That is, one is fundamental qualitative characteristics, and the other one is okay, fundamental qualitative characteristics. Other one is enhancing the characteristics. Qualitative characteristics means what? We know how to measure in numbers, prepare a balance sheet, P&L. But how to make it useful? Not just through numbers, we should give some non-financial information, qualitative aspects. For example, guideline factors, principles to be applied while making a decision, what accounting policy to be selected, what method of depreciation to be followed, things like that, for some guidelines to be given. Okay, so it is a trade-off between fundamental qualitative characteristics and provide useful information about the economic phenomenon. Okay, what do you mean by that? Let me explain. Fundamental qualitative characteristics are two: relevance and faithful presentation. If you remember, we used to one word called as true and fair view. In accounting standards, in Companies Act, even in auditing, you might have heard that word. True and fair view is the primary objective of financial statements. I hope you have heard of it. Right? True and fair view. Now the same term true and fair view in today's world, now they're using the word relevant and faithful presentation. Relevant means it should help. It has the predictive value or confirmation value or both. Predictive value, help you estimate about future cash flows. Confirmatory value, whatever you thought, okay, something is being confirmed. Making a difference in the decisions, to help you make a decision, maybe to invest, maybe to become employee of the company, or regarding some investigation about the company. Includes materiality concept, omitting concept, misstatement, or which could influence about the decision of financial statements. Ultimately, when we prepare balance sheet or P&L, it should be relevant and faithful. Faithful means it should not have any biasness. It has to be neutral. Some people should not say a managing director bias is influencing the accounting policy. It should not happen. It should be without any biasness. It should be on a neutral principle. Complete, all the necessary informations are provided and free from error. No omissions or commissions knowingly. Something should not be there. So these two are called as the fundamental qualitative characteristics. Then we have qualitative, enhancing qualitative characteristics. So what we've done is fundamental qualitative characteristics. Next we have is enhancing qualitative characteristics. That is additional points. These points, if you keep it in mind, your fund statements will become more useful. What are those enhancing qualitative characteristics? That is comparability within the company, within the same sector. That is, if you are in software technology, Infosys, TCS, you try to make sure that your fund statements are comparable. Verifiability, so that if you present some amount or some statement, the people will be able to verify. For example, you might know, if you take a loan, you have to file charges, and you go to MCA, you can find the charges filed. So the charges amount there, and in the balance sheet, you should be able to verify. I mean, something like that. Or GST returns you have filed with the sales, and your income statement sales data and GST sales data should match approximately at least. So this verifiability, comparability, timeliness, so that it is prepared at the time. Which will help the users to make decision. Understandability, so that it is classified, presented, summarized in one place rather than being into different places like that. Cost constraints. This is one important point. Cost constraints on making a decision. Sometimes when the standard says that you have to do, for example, retrospective calculation. So if you change from cost policy to revaluation model, you should go back 2 years and change the historical data, the books of accounts. That's called as retrospective calculation. Now the cost may not justify it sometimes. Going back 20 years and change all the data points, prepare new books of accounts may not justify it. So the benefit of what you're getting with the help of changing the accounting policy, method, the cost what you're incurring, the benefit what you're getting, you try to apply a fair degree of judgment, and that's what you have to consider, the cost and benefits of applying those decisions. Okay, so this is what is qualitative characteristics, talking about the two important aspects, and fundamental qualitative characteristics and the enhancing qualitative characteristics, keeping it in mind the cost constraint on the useful information that you're going to get. And remember these two words, like a true and fair view, here we have relevant and faithful representation. Okay, so next we have financial statements one by one. For example, a balance sheet should show asset, liability, and equity. P&L account should show income and expenses, and notes and all should give you additional information to help you, the investor, to make an assessment. Going concern assumption, people know it. Still, I'll repeat it. The business which is being carried on is going to be continued in the foreseeable future. No intention or necessity to liquidate in the future. If going concern assumption does not exist, it means you have to prepare the financial statements completely different. Assets will be recorded on realizable value basis. Liability will be recorded on the settlement value basis. And the reporting entity, you have to prepare, if it is consolidated financial statements, you prepare holding company plus subsidiary company put together. If you have unconsolidated financial statements, then you have only a holding company. Combined financial statements, that is, they're linked companies but not holding and subsidiary. This is a special situation which will not, at least I've not come across in India much. Combined financial statements means one company, other companies to be combined because of some legal requirements. These are not holding subsidiary, are not associate, but they have to be reporting on a combined thing. For example, just before merger. You understand? Just before merger, you have to present to the court maybe what will be the impact of merger. So even though merger did not take place, as if the merger is taking place, you have to combine and present the financial statements. So that's called as combined financial statements. It's a combination of multiple companies but not related by holding subsidiary. They're called as combined financial statements. What are the financial elements? Broadly, asset, liability, income, expense, and equity. So what comes in balance sheet are three things: asset, liability, equity. So what is an asset? Asset is a resource, present economic resource, controlled by entity as a result of past event, having the right to potential FEB, future economic benefits. So what is the main difference between asset and an expense? You understand the difference between asset and an expense. Asset means the benefit is yet to be derived. Expense means benefit already exhausted. That's why it is result of past event having future economic benefits, FEB, future economic benefits. And the rights means you may be with respect to right to use the machinery or right to use intangible assets, like you have copyrights, or when you have a copyright, you can stop others from using it. So both type of rights are considered. So certain right corresponding to obligations of another party, you have right to receive money from debtors, means your customer has obligation to make a payment. Certain rights are established by the contract or potential to produce economic benefits. You have machinery, you have furniture, they don't have any obligations of another party. So you have debtor, other person are creditor. You have an asset, other person has obligation. That is also a right. But you have machinery, nobody has liability, but using the machinery, you can produce goods, you can sell and make profit out of it. So ability to make benefit is also a definition of an asset. And you can also consider probability points, role of timing, when the potential cash flows will come into picture, when are you going to manufacture goods, then you are going to get the cash flow. And sometimes the selling price is not fixed, the selling price will be fluctuating, the benefit cannot be accurately measured, so you need an estimation. Time value of money might be there. Sometimes role of expenditure also will be involved. You have to incur some expenses to make sales happen. So, and contract, ability to direct the use. So ultimately, asset is a resource controlled by entity. It should be under your control. If it is not under your control, it is not going to be an asset. Again, please focus on the word controlled by entity, not owned by entity. You may not own the asset, but you control the asset. A typical example, hire purchase. When you purchase the goods, you will become the owner only on the last installment. But until then, you continue to be deemed to be the owner. You are using the asset like an owner. So that principle is, it is shown as the asset of the hire purchaser is a typical example. You are controlling the asset, you are not owning the asset. Ownership is not the thing. You should be able to control the asset for the benefit of your business. Okay, that is asset. Liability is exact opposite. It's a present obligation, outflow of economic resource, and result of past events. Key aspects: no practical ability to avoid. You can't avoid that liability. It may be legal obligation, provision for tax. It might be contractual obligation, contract with employees, or a constructive obligation, means you have accepted. There is no legal obligation, there is no contractual, but you have been doing it on your own. For example, you pay Diwali bonus. Deepavali bonus is not a compulsory thing, but you have made the practice yourself in the past 10 years. So you made an obligation for yourself. That's called as constructive obligation. Common aspects: unit of account, a group of accounts or group of rights, executory contracts. You will discuss more when we go to Ind AS 37, and substance of contractual rights and contractual obligations. So sometimes you have right to receive and obligation to make the payment. Both of them can exist. Equity means basically it represents a residual interest, means you have an asset, you have a liability, you pay all external liability, whatever remaining is called as the residual interest, and that's the definition of equity. What about income and expenses? Income is enhancing the assets, increasing the assets, or decreasing the liabilities. And expenses, opposite. Expense means it is decrease in asset or increase in liability, but it should not be because of other contributions. For example, contributions or fresh capital received by issue of shares, that also will increase the asset. That's not an income. So income means increasing the assets or decrease in liability, but not including contributions like a fresh capital. Expense means reducing the asset, increasing the liability, but will not include anything distributed like dividend. So that is the definition of income and expenses. Recognition principle: when will you recognize and when will you de-recognize? In fact, this recognition de-recognition principle comes in every standard separately, but as I told you, this framework is a guideline factor for the standard setter. Anyway, so recognition means what? Capture for inclusion. Should we take it into books of accounts or not? Should we capitalize or not? Income, expenses incurred in acquisition of an asset, for example transportation charges, should be recognized as balance sheet when capitalized, or should it be taken to P&L account? So you will take it as asset or liability if it is relevant and faithful presentation. What is this point called as? Remember, relevance and faithful presentation. We just now discussed qualitative aspects. Two types of qualitative aspects were there. Do you remember? Just now we discussed two types of qualitative aspects. Can you recollect what is the two types of qualitative aspects that we discussed? No, relevant and faithful presentation is a 2 points, but above that, what we discussed is fundamental qualitative aspects and enhancing qualitative aspects, right? So under fundamental, the true and fair view, and here we call it as relevant and faithful presentation. That condition should be satisfied. Relevant to the user's existence, uncertainty, or low probability. So consider these points: probability, estimation, time value of money. And faithful presentation: if uncertainty is there, make a reasonable estimate, make an assumption. You can also put any other information to understand about the existence of a product, existence of an asset. You can make a assumption, you can make a judgment, you can make an estimation. When will you derecognize? When you take out from the books of accounts, derecognition. Asset when the entity loses the control, liability when there is no more obligation. In those two cases, you will take out the asset and liability, you will derecognize. Measurement principle, what do you mean by measurement? Quantifying it. Quantified in monetary terms. Measurement basis, we have historical cost and current value. Historical cost means the cost at which you have purchased historically. The price is available in the form of bill, amount spent. Current value means existing, what is the value. So we have two types there. One is called as entry value, other is called as exit value. Entry value means today if I have to purchase, and exit value means today if I sell the asset. So exit value is a fair value. If I sell the asset today, normally in an orderly transaction between market participants, not between related parties, how much value I can receive. In a normal fair transaction, what I can get by selling the asset. Or if I use the asset, by using the machinery, I can get the future cash flows, a present value of it. It's called as value in use. In fact, these terminologies you will come across even in other standards like impairment of assets. Anyway, this is called as exit value. Basically, you are using the asset or you are selling the asset. Entry value means you purchase, current cost of consideration to be paid, and you adjust for any transaction cost to be incurred. And again, same points will come. Relevance and faithful representation. Which method you follow? Will you follow historical method or will you follow current value method? For example, you are having building. Now tell me, which method is most appropriate for valuation of building? Would you like to go for cost model or evaluation model? Now, you might say cost model because building value does not change much. Or you might say building value will change. Sir, for example, my factory building is in the outskirts of the city, industrial area, where value will not change much. I'll go for cost model, historical cost model. But my office building, my central office is in the heart of the city, Nariman Point, MG Road, like that. Their value is very, very fluctuating. So what is most appropriate to reflect the market value? So you follow revaluation model. I hope you're able to get the point. The meaning of true and fair view. How we choose the accounting policy, we have to go for what factor to consider? Relevance. In terms of characteristics, the cash flows changes, sensitivity factors like market value change, our value also will change, contribution to cash flows, indirect cash flow, direct cash flow, various other points. Faithful presentation, follow consistency rule. If there is an uncertainty, make a measurement, make a faithful assumption with a reasonable judgment and factors available. And multiple measurement basis, can you follow? Yes, I just told you now. For a factory building, you can follow cost model. For a office building, you can follow revaluation model. So multiple measurement basis, you can follow it. Measurement of equity. Equity is not measured. It is not measured directly. It is not designed to show the value of the entity. It's a residual interest. See, we have standards to tell you how to value assets, how to value liabilities. As a result, we prepare balancing figure as P&L, and that's how equity is ascertained. We don't value reserves and surplus. We don't value P&L account. We value sales. We value expense. Salesman's expense is P&L account. Hope you got the point. Equity is not measured. Equity is always a residual interest. Presentation, ultimately what and all point to be kept in mind. To facilitate effective communication, the user should understand with a reasonable background. Duplication of information to be avoided. Entity-specific information is more useful than standardized descriptions. So when you try to prepare annual report, notes to accounts and all, try to give the entity-specific objective or what you are planning to use the machinery for, what is the accounting policy adopted by you specifically. Entity-specific information will be more useful. Classification and aggregation. Classification means, when you show in the expenses, What are the expenses you will show? Of course, P&L account format is there. Employee benefit expense, financial expense, cost, depreciation, other expenses. In other expenses, you can tell administrative expenses, manufacturing expenses, traveling cost, or research and development expenses. See, if it's a pharmaceutical company, research expense is more important. For a portfolio management service company, they might spend more money, like mutual fund, they need to spend more money in marketing, so marketing cost is more important. So every type of business, a sector, has to define the classification type of expense which suits their entity the most. So sorting of assets and liabilities, common characteristics apply to unit of accounts. You can offset also, sometimes you are receivable as well as payable, you can set it off. Classification of equity, you can show, under equity also you show under various characteristics. If you look at the schedule 3 format, you will know capital reserve, security premium, capital redemption reserve. So according to different characteristics, even equity items are separated. Same income classification, P&L account, other comprehensive income classification. Aggregation means when things are shown together. So certain things need not be shown separately, we can aggregate and show it. That's what is called as aggregating, means totaling certain things who have shared common characteristics. Okay, so this is the brief things about what we call framework for preparation of financial statements. We have one more, but that is not a change that has happened, that is already there, but still continue to be there. Let's discuss that also. That's called as capital and capital maintenance. Okay, this is slightly tricky concept, but important one. So I want to make sure that we go it in a comfortable speed. But before that, if you have any doubts in these things, you can ask. Quite a few charts are there. I'm not sure whether you are able to take down the screenshot of it. I'll do one thing. I'll share all these charts at a later point in time in the Telegram channel. I'll share all these things, so you can go through it comfortably. Don't be in a hurry. So, but if you have any doubts on any of these things, please ask. I'll quickly go through it once more. We started with the basics. 2 minutes applicable. General purpose financial statements, in the sense what a balance sheet P&L account should do in generally, and the qualitative characteristics, fundamental, then enhancing. We discussed those points. Then financial statements objective, that is what the P&L, balance sheet, and cash flow statement all should do. And elements of fund statements, assets, liability, income and expenses, equity. And recognition, what points to be considered, derecognition, what point to be considered, and measurements, what are the different measurement principles that are existing. We can also do multiple measurement bases. And presentation disclosure. So when you prepare balance sheet P&L, how would you present in a better manner? Keeping it in mind, what notes to accounts you can write, how to group certain things, you can offset certain things, you can total it if they are having similar characteristics. Things like that is classification, aggregation, and objective principles. So we just have discussed concept of capital and capital maintenance. That we can, after this, we can go for some problems to understand about the measurements. Okay, any doubts on these points what we discussed so far? I'll wait for 1 or 2 minutes. If you have any questions, please ask. Okay, so I believe no specific questions are there. I'll go forward. Okay. This point, it's appropriate if you can understand from the point of view of financial management angle rather than accounting angle. What do you mean by this? So when you want to start a business, can you tell me what is the first thing you need? If you want to start a business, what is the first thing what you need? If you want to do any business at any part of the world, you need capital. Absolutely. And it is not only for the first year, subsequently also you need money. Okay, let me ask you now second question. What do you need the capital for? By having capital, what will you do with that? You are going to use for purchase of machinery, purchase of building, paying rent, paying salary, for operational purpose, investing purpose. Ultimately, can I say capital means you have purchasing power? Purchasing power means don't go literally purchasing power. Ability to spend, ability to obtain services, ability to obtain assets, ability to get the service of employees. That's what I mean by purchasing power. So ideally, again, I focus on the word ideally. When we prepare the balance sheet every year, it should tell me this. How much capital I have I maintained it correctly or not? Conceptually, you got the point. My balance sheet, my financial statement should give me the purchasing power an entity has. If opening, let's say equity, that is share capital plus reserve surplus, opening equity is 1 lakh and the closing equity is 1,10,000. Opening 1 lakh, closing became 1,10,000. So 10,000 is the increase. Opening assets 1 lakh, closing assets 1,10,000. So your value has increased. Absolutely. But now let me ask you second question. Is your purchasing power increased? If I tell you previous year salary is 1 lakh, current year salary is 1,10,000, your salary increased, but can you purchase more items? Have you become more rich? Has your standard of living increased? So for that, what would be your answer? Your salary increased means, does it mean that you have become rich? Is it true or not necessarily? If your income increase, does it mean you have become rich or no? Not necessarily. Not necessarily. Why? Because cost also will increase, right? Purchasing power. I mean inflation, absolutely, inflation. Now, we would like to bring that into books of accounts. If a company reports more profit, does not mean companies purchasing power increased. We would like to report all these things. How much increase, how much is the purchasing power, but still as of now, we don't know how to incorporate that in the books of accounts. So this concept what we're discussing is not applied anywhere else. It is a ideal scenario. So going back to the word, it is ideal. It is not practical. If I have to tell you other way around, I'll just share quickly one small incident. I went to Indonesia. See, so far you always have seen 1 USD is 80 rupees, 1 euro is 85 rupees, One Australian dollar is 45 rupees. One Singapore dollar is 35 rupees. Like that you have seen. Have you come across anywhere 1 rupee equal to so many things? One of the things I witnessed is in Indonesia, 1 Indian rupee is 200 Indonesian rupee. 1 rupee is 200 Indonesian rupee. So if you have 1 lakh, Indian rupee means what? If you have 1 lakh rupee in Indian terms, which means you have 2 crores in Indonesian rupee terms. Suddenly you become rich, right? But only when you go there you understand. Even to go to bathroom you have to pay 2000. Indian terms 10 rupee. Here we don't pay 10 rupee and all. Some people don't pay at all. So just because you have more money there, 2 crore you have, you cannot buy the facilities, you cannot buy the goods. So richness is not about just increase in numbers. Richness is about ability to spend money, purchasing power. Inflation is one of the important aspects. Anyway, so that's what I always say, no? So many people, anyway, that will come to the different topic. Let me not go for it. Concept, hope you got it. Capital means purchasing power, and we would like to report it. What are the types we have? Mainly we have financial capital, which is what presently we follow. What is financial capital? Increase in net assets. Then we have physical capital. Physical capital means that I'm talking about the purchasing power. Physical capital means this purchasing power. This is what that we are trying to understand, purchasing. Now this is ideal, but it is not followed anywhere. So at present we follow this. Financial capital is followed at present. So physical capital not yet followed. This chart and all is there in the material. Don't have to write it down. Just understand. If you want, you can make a note like this in the chart only. If you have. Anyway. So when we do numerical problem, you'll understand better. I'll take a numerical problem on this. But conceptually you got it. Financial capital is just book value. What is the change? But physical capital, we would like to understand what really happened to your purchasing power. Increase in the capacity, capability. That's what I mean by purchasing power. So far, it is still only at conceptual stage. It has not come to standard stage. It can come in the future. Before that, you pass the exams. When I was doing CA intermediate, I had 6 subjects. Then people had 7 subjects. I mean, your seniors had 7 subjects. I think some of you have 8 subjects. I think now you have 8 subjects. Future, what would happen? 9, 10, I don't know. So before anything new things comes, you pass the exam. That's the best way to avoid all these new concepts. Anyway, so let's take a numerical problem to understand this concept of capital and capital maintenance. This problem is there in the middle, I believe. In fact, solution is also there, but let me explain conceptual. So when I take this numerical, things should become more clear. Just give me 1 minute. Okay. Mr. Unique commenced business on 1/4/2017, represented by 5,000 units of the product at ₹4 per unit. During the year 17-18, he sold 5,000 units at 5 per unit and during 17-18 he withdraw rupees 4,000. 4,000. Okay. On 31/3/2018, the price of the product is 4.6 per unit. Average price indicates on 1/4/2017 100 and 31st March 18 120. Find out financial capital at historical cost, financial capital as current purchasing power, and physical capital maintenance. Okay, so let me do it in a columnar format, but before that, opening was 20,000 represented by 5,000 units of the product at 4 per unit. During the year, he sold 5,000 units. So what is the year-end value? Year-end capital. You have sold 5,000 units at 5 per unit. And so you have received 25,000, but you withdraw 4,000. So closing capital is only 21,000. That you agree with me? Closing capital you have 21,000. Now tell me, what is the opening capital you had? $5,000 you sold at 5 rupees. You got 25,000. You withdraw 4,000. Closing 21. Opening you had 20,000, right? So 20 became 21,000. So profit is 1,000 or incremental amount, increase in net assets, whatever you can call it, increase in net assets. Which is what we call as financial capital at historical cost. So let me give the heading, financial capital at historical cost. Then financial capital at purchasing power, at current purchasing power. Current purchasing power. Then financial capital at, so not financial capital, physical capital. Last one is physical capital. So financial capital at historical cost, financial capital at current purchasing power, physical capital. Okay, so what I'm going to do now, this will compare with the closing capital and opening capital. The difference will give me whatever the retained earnings or incremental value. You can say retained earnings or incremental value. Okay, now first one I told you now, for closing capital 21,000, opening capital 20,000, so retained earnings 1,000. So it seems your financial capital increased, right? Right, financial capital increased, correct. 1,000 rupee more you have. You have 1,000 rupee more, correct. Financial capital increased. Now, is your purchasing power increased? Now let's look at it. Opening capital 21,000. Opening capital, closing capital 21,000. How much opening you had? 20,000. And what was the purchasing power then? Average price is 100 and closing average price became 120. Getting the point? So that means, can I say All the products have been increased by 20%. So if you want to buy or if you want to maintain the same purchasing power, your opening capital should increase by 20%. Getting the point? You had 20,000 when the price was 100. Now if you want to maintain the same purchasing power, you need 120, which means 20,000 multiplied by 120 divided by 100. So you need 24,000. Are you getting my point? Beginning of the year, 20,000 was sufficient. At the end of the year, to maintain the same level, you need 24,000 capital because prices have increased to maintain same purchasing power. But what you're having? 21,000, which means you lost the purchasing power by 3,000 rupees. 3,000 rupees return profit negative means your purchasing power reduced to that extent. Financial capital, you might have more money, your purchasing power reduced. Okay, now coming to physical capital. Financial capital is a average price, means economy on an average considering many products. Physical product means particular product. What product you had particularly? Some products you had, unit of product. And how much is cost at the year end? It cost 4.6 rupees. In the beginning, you have 4 rupees sufficient to buy 5,000 units. Year end, how much you require to maintain the same physical capital, ability to purchase the 5,000 units? You need 5,000 multiplied by 4.6. Only if you have that much money, you maintain the same physical capital level. 5,000 into 4.6. $23,000. But how much you have on hand? Closing capital 21,000. So year end, you have lost 2,000 capacity. Your physical capital reduced because you will not be able to purchase the same amount of units. Okay, so I hope you got it. So write down the solution. See if you have any doubts.